Dear guests, welcome back. I'm delighted to announce this next fireside chat, Personal Finance Management, your essential checklist. Joining us on stage is Jimmy Moyaha, founder at Lebowa Capital, and Nicolette Mashile, founder at Financial Fitness Bunnies. Jimmy, Nicolette, we are looking forward to your discussion.
Thank you very much for the introduction, Despina. I will skip formalities, and primarily because everybody knows who Nicolette Mashile is. Those of you that don't, she's the founder of Financial Fitness Bunnies. She's got the Financial Bunnies TV channel on YouTube. She's very, very active in financial education, and she's a dear friend of mine, and that's where I'm going to leave it, because the important things that we're going to discuss are around planning your personal finances. I think it's such a critical area that we often overlook. Sometimes we don't know where to start. Sometimes it feels sort of overwhelming. And perhaps there's some little nuggets of information that we might be able to share between the two of us that hopefully can help you make a financial decision going forward, or help you in whatever decisions that you are looking to make. So Nicolette, thanks very much for the time. Thanks for joining me and agreeing to be the guinea pig. Let's get into it. Let's start with why someone would need a checklist. Why would you even want that?
All right. Good evening. Are you guys good? Awesome. Jimmy, thank you very much. Look, I think you need to have a checklist because ultimately most of us don't know what we don't know, right? And I'll give you an example. Last year, December, I decided to go on a date, roller skating date, and throughout my year, the whole of last year and probably a couple of years before, I never thought I would have a medical emergency. So in actual fact, I was saving up for in case I ever need to go to the hospital, right? So I didn't take up medical aid, I didn't have medical insurance, I never had any of those because I just did not believe that I would get myself in a situation. So I went on this roller skating date. You can imagine, have you guys seen the movies where they hold hands and they're skating? Yeah, it looks very cute, right? 5 minutes onto the arena, I fell, I broke my ankle in 2 places and I dislocated it. Went into hospital. At the hospital, the first thing they asked me, medical aid or private? And I thought I was really cute when I said private. And they were like, okay, this is the amount that you need to drop. It was 150,000 rand just to be admitted. Not the orthopedic surgeon, not the anesthesiologist, that one, not the x-rays, not the blood tests, every single thing hospitals have now outsourced. So the reality is, until something like that happens to you, some of us don't have the contingencies for it. So that's why we then put together a checklist to make sure that you don't find yourself with blind spots. And let me tell you what often happens, right? In South Africa, like many other countries, a lot of 40% of our people are employed by the state, and then maybe around about 20-30% private sector. And generally, people then have what is called employee benefits. So they've got a retirement plan, they've got medical aid, they've got group life, then they've got employee-assisted programs, which then means that a lot of people do a thing where they say, my finances are taken care by the employer. I don't need to do anything about it. But that is leaving you with blind spots. So that's why we put together this ultimate financial checklist to say, I have the risk mitigation. I have the investments for tomorrow. I have the retirement forever. I have the will to make sure that when I'm underground, I'm not fighting with other ghosts because my kids are not taken care of. That's ultimately why we put it together.
I like that you broke it up into a couple of categories, and I want to get into each of those categories because I imagine there's different components within each one. But before we get to that, I must just make a comment around your ankle situation. Aren't we glad NHI has been passed now? Hopefully that ends up well for the rest of us. It remains to be seen whether or not it will be implemented properly. But let's get into that checklist. You mentioned that there are fundamentals and there are certain key things that you sort of look at first, and then you start to build on from the checklist. What do we start with?
We start off with budgeting. So you see, a lot of people want to downplay budgeting because it feels tedious. Let's just be fair. It's a tedious exercise to sit there and write, oh, I make 100,000 rand in a month. I need to allocate this much to this much to this. But in reality, many of us have plans. We've got ideas. We've got the life that we want to live. But the reality is, if you don't make space for it in your budget, it's never going to happen. So what happens is, and I always say, we have a thing called income rich, where people are rich when their income comes in, But because they don't have a budget, the income kind of floats around. They use it for things that they need to, I call them operational things in their life, which is essentially your living expenses, pay for a couple of things, then sit with a disposable income. And then that disposable income becomes a framework or a lens. So a friend says, Chomi, let's go to dinner tomorrow. You go through the disposable lens and you're like, I still have 40,000 rand, let's do it. Friend says, let's go to Dubai. Again, through the same lens, let's do it, right? And then you find yourself in situations where you've got more month than you've got money, and all of those financial goals, you keep putting them back. No, we'll see next month, we'll see next month. And that's the problem. Your budget essentially will tell you what kind of checklist you'll have.
Now, we're not saying deny yourself of nice things, right? Let's be clear.
Of course not.
We're just saying plan for the nice things so that when you want to experience them, they're not a constraint on everything else.
Absolutely.
So let's take another aspect of this budgeting process, or how we move forward, right? So we've got the budget, we've outlined what we want to be spending on, what we want to be saving towards. Let's look at that. How do we define the saving goals? What should we be prioritizing from that disposable income so that the employer gap that is there is not left there? Because the employer, like you said, might cover a pension plan or a retirement annuity, but what don't they cover?
Yeah. So I actually was in Botswana 2 weeks ago, and there was a lady from Standard Chartered who put it so well. She said, you need to think about today, tomorrow, and forever, right? So today, what are you saving for that is going to keep your life and the type of living standard you want to maintain for yourself? So those are mostly your short-term goals, right? So you perhaps are maybe saving for a holiday. You want your family to have one overseas holiday every single year. And then you look at tomorrow. What are we saving for tomorrow? Okay, maybe we want to supplement our retirement with a property portfolio. So what you got to do is, remember, retirement is a forever, but you need to go to the forever and check if it's enough, right? That whole thing about 6% of South Africans, only 6% of South Africans can retire comfortably, that is essentially, that comfortably is you can replace 75% of what you're currently earning now when you are in retirement. And the majority of us can't do that. In reality, if you were to go and do the retirement calculator right now, it will be the biggest reality shock of your life to realize how much you are actually saving, and then finding out that you actually need to supplement it. So I fight with retirement companies all the time because I say, you don't need a paper asset retirement fund, you need funds in retirement, whatever shape form they come in. So let's now make space for retirement, but let's make for supplementing the retirement. So are you putting together an asset allocation that's got real estate, that's got a portion of trading, that's got a portion of bonds, equity, all the different kind of asset classes, so that you give yourself an opportunity to have an all-weather portfolio, investment portfolio, trading portfolio, whichever way you're going to look at it, right? And then there's the risk mitigation. I think the risk mitigation is probably the one that a lot of us think, it will never happen to me. I'm such a good driver. You know, I'm such a great driver. I'll never get into an accident, right? A lot of us think like that. Or perhaps you're thinking, why do I need life insurance for? I don't have children, right? But then you go take a property on a home loan, and where are you going to see that property or that debt of that property? So then you have to look at, what is my risk currently? What type of risk should I need to be planning for? Is it medical? Is it life? Is it short-term insurance? Do I have a lot of assets that actually need some sort of coverage? So I think for me, those are the things that you need to make space for. So when we're teaching the kids, we always say, differentiate between savings and investment, and then add in risk mitigation. And then you've got a formidable strategy, right? Then your next step is, what then does my estate planning look like? Because you may need to actually make space even for estate planning. It might not necessarily be specific products or specific products, but you may need intermediary services to be able to put together your estate plan so that, again, when the unfortunate time comes that you do die, it's well taken care of.
I think one of the things I love most about you, Nicolette, is Coco, right? You built Coco so that you could explain how all of this happens, and you started at a fundamental level, at an ECD level, at a child who's starting out school, who understands principles that we wish we were taught, because let's be honest, some of the things that we went through school, you don't really know if you use them in life today, but there are certain things that you wish you had been told how to navigate, or at least taught how to navigate through those conversations. Before we move to the estate planning side of it, I want to look at risk mitigation, but I want to look at it from something you said around what you teach the kids. I want to look at an emergency fund. A lot of people say an emergency fund is 3 months. A lot of people say it's 6 months. But I know you and I have had conversations, and you say 12 months is a good buffer. Why that?
Look, I think 12 months is a good buffer. Essentially, it's you need to look at your life and understand what your situation looks like. One, sometimes we need to have frank conversations with ourselves, right? As Nicolette right now, I know my months. I understand the work that I do, and in the space that I'm in, there are certain months that are going to be dry months. And I'm very much well aware of that, right? So for instance, I know that financial year picks up in April, right? April, the brands will start giving us work up until maybe your October. From October to December, it's quiet, right? So I understand my financial situation. You need to understand your own to be able to decide how much of a buffer do you need. Okay, let me put in another example. Let's say you're an employer and you are a PR specialist, and nothing to the PR specialist. But those types of jobs take a little bit longer for you to be able to secure the next job. So let's say you get retrenched. How long is the turnaround for you to secure the next job? You need to think of those things so that your emergency fund then speaks to you, right? But you also don't want to find yourself, we are now in month 3 of you not having a job. Now you start to panic because emergency fund is running out. So what now? Now you start taking even the lowly jobs that you're being offered. And hence why that 12 months becomes a confidence booster for you. It's a buffer. I still have 12 months to make a decision. I mean, come on. Even the trustees on a pension fund have 12 months to decide who to distribute funds to. You know what I mean? So for me, that's the most important thing. But it also begs us to ask ourselves the question, going back to the risk mitigation. You know that when COVID hit South Africa, it was the most saddest scene to see people having to get their cars repossessed. Now, granted, the bank doesn't just click their finger and your car gets repossessed, right? It's a bit of a process before you get there. But a lot of people were going back who were maybe had to be retrenched or take voluntary retrenchment or lost their job or lost their source of income. But they never actually tapped into one of the most uptaken insurance policies in the country, but the least used. Credit life insurance. Many people don't even realize they have it, right? And that was the insurance policy that was supposed to step in and be able to assist people. So you have to then ask yourself the question, if I say, for instance, I've got 12 months worth of emergency fund, is everything else covered? Because essentially, your emergency fund is only supposed to cover those living expenses where the financial services sector has not created a product for. So things like your school fees, things like your groceries, right? But everything else, your car has got an insurance policy. Your debt has got an insurance policy. Your house has got an insurance policy. So essentially, you do have those insurances to be able to assist you if you find yourself in a temporary disability situation, if you are dying, or if you are retrenched. Of course, it's not if you just decide to leave the job. Please, man.
Okay, Nicolette, let's look at the rest of the checklist. So we've run through the budget, we've run through having an emergency allocation, we've run through just understanding what your situation is to better prepare you for your budget. And you mentioned something around planning for the forever, planning, and I suppose that's where estate planning comes through. I know a lot of the guys sitting in the room were at a trading expo, and a lot of what happens in trading is I'm on the platform, I'm trading, I'm making enough money to sustain myself, sustain my ecosystem, build up a buffer on an account so that I can be financially free and financially independent. So that doesn't leave a lot of room for us to think about estate planning. How do we get to the basics of then saying, in as much as this is my everyday, maybe I can divert some of the funds towards a home loan or towards something that'll benefit my estate in the long term?
Look, I think, Jimmy, it's important for us to take it a couple of steps back, right? If you are going to be looking to secure your financial future, you need to know what the future looks like for you. I think a lot of us are just waking up every single day and doing the everyday thing that we do without realizing that we're eventually going to get to the future. So you've got to have clarity, because your future and my future might not look the same, right? And essentially then it means that you need to understand what goal-based investing is, right? So whatever it is that you're going to secure in your future is dependent on what you are trying to achieve. So I think the first step is really making sure that you diversify how you are earning an income. So yes, I'm earning an income through trading, but where else am I putting money away so that I can start earning passive income? There's a gentleman by the name of Dhaval Bhatia. He's one of my favorite scholars, right? So he's got the 7R theory of building wealth. Basically, he says 2 ways, 2 R's are active. So it's either you are in a job or you are selling something, right? And then the other 5 R's are passive. And we know, we say passive with a pinch of salt, because even rental income is not passive, right? So you then need to take those different R's. So the R's that he's got, I think it's rights, royalties, rent, return, and replication, right? So you need to take those R's and kind of fit them into your life and say, where do I need to put my money so that I have a diversified way in which I am actually going to be deriving income? So do I need a passive income? Yes, okay, I need a passive income, something that is outside of me, which then means that I need to look at what assets are out there that allow me to be able to have a passive income. So as I said, rental income, we all think it's passive income until you're actually in it. It takes a lot of scale for you to get to rental income, to passive income. Paper assets. Your equities, your bond market, it's there, it's available, right? Unit trust, ETFs, whichever way in which you're putting together your mutual fund or your investment portfolio will depend on what you are trying to achieve. 1. 2, you've got to look at your life stage. I think a lot of us also, and in South Africa we love doing this, where we go on social media, they love doing it on Twitter, where somebody says, guys, what are you investing in? Charlie, what are you doing? What are you doing? We can't all be investing in the same thing. We're not all trying to reach the same end goal, right? So it's important, again, for you to go and sit with a financial advisor and map out what you are trying to reach so that you've got the right type of asset mix or type of investment mix based on where you are right now. Because let's say, for instance, I'm Nicolette, I'm 35 years old, I have no kids, and I can be as risky as I want, right? Because essentially, I've just got Nicolette to take care of at this point in time. But somebody else who may be the same age as me, my age mate, who maybe has 1 or 2 kids, they've got to now think about securing the future, not only for themselves, but for the child too. The third thing is, what is my risk profile? What type of person am I? Am I the panicky person? And sometimes you've got to look into your own personal life to really assess whether you're a panicky person or not. Because most of us think we're all so calm and cool and collected when it comes to money. But your actual ego and who you think you are and general psychological biases will step in when it comes to where you are putting your money and how you are putting it, right? Then I think the last thing you need to consider is, when I get there, how have I protected it? So when I do get the investment portfolio, when I do get the property portfolio, when I get all of these things, do I need to sit down and write a will? Do I need to put all of these assets into a trust? So it's about also how you want to do that wealth transfer to whomever you want to transfer it to. That, I think, is also critical. But you spoke about the kids, and it's quite important, because what we often see is that there's a breakage of, I want to call it, what is it called? It's like there's no knowledge transfer to children. So the parents make many sacrifices, they work really hard, they build the generational wealth, and then it takes one generation.
And they just hand it over to the next
Hand
generation.
it over, and it takes one generation to break it all down. And that's why we teach children, even now, if you do have a child and you are giving them pocket money, please stop doing that. Because children need to understand that money is not earned just by being alive.
So I saw an interesting thing about the pocket money. I think I saw a video online where a parent would pay a child to do a chore, right? And in paying the child to do the chore, immediately after paying the child, once a week or maybe once a month or whatever, they sit down with the children and they tax the money. And you explain to the child the principle of the fact that life is not everything that you earn. And I think I don't need to speak to the traders in the room. We've all gone through a situation where the market's not giving you what you want, or you're not hitting your target, or the account balance is not growing at the pace at which you want it to grow at. And that puts pressure on you. That puts pressure on being self-employed. And even if you are looking at other opportunities, let's say you're formally employed, you start to leave your work responsibilities because you're like, I must focus on this trade, I must make up for the money that I missed here, or stop losses were hit wherever. So I think the mindset that traders have is very much one of understanding how to survive, because we have to. You have to sit there and it's sink or swim, quite literally. And I want to come to how you then transfer that kind of mindset into a checklist around financial management so that you don't panic, so that you don't transfer your insecurities or you transfer things you shouldn't be transferring, and you can still see the bigger picture around why this checklist is in place.
You know, I think you're spot on. So when Despina asked, what do I want to talk about? We played around with a couple of ideas, and we landed on this one specifically because we're speaking at a trading summit, right? Traders have the ability to make money. They know how to make money. But it takes a certain set of skills to keep money. And that's where it gets a bit lost, right? And that's why we speak about behavioral economics, and we say you need to understand who you are. And often, sometimes, you need to actually sit down and map out where your own blind spots are. So from a financial perspective, we can give you the checklist. But in reality, we know money is 80%. 80% emotion.
And my blind spots are not the same as your blind spots.
Absolutely not. Because also, remember, we've got what we call money scripts and money beliefs. And most of the time, they are formed, they are ingrained in us by the time we hit the age of 12. By the time you hit the age of 12, there's a lot of things that it's very difficult for educators to change in children, right? That's why priests say, give me the child for the first 12 years of their lives, and you will never change their religion after that. So in reality, traders need to know who they are from a psychological perspective. Because the skill to make money is one that I think a lot of us learn through losing, gaining. You start to understand patterns. You start to understand how to do your analytics. You start to see what the market is for. You kind of get a sense of getting into a groove. The question is, what happens when someone disrespects you and then you start bleeding your money? What happens? I mean, I was standing outside by the window there. I looked down. I saw Lamborghinis. I saw M4. I was like, yeah, the boys are here, right? And there's nothing wrong with that. But you've got to understand it's doing it for me. It's not doing it for the eyes. It's not doing it for some sort of outward reward. It's I'm buying this thing because it's for me. So there's a lady who does psychology, money psychology, and she says, all of us have different personalities. So I call myself the financial bunny. So the financial bunny is the person that's sitting here. This is the logical person, right? Very logical. Here is Coco. Now, Coco's problem is Coco doesn't like to be undermined. So I'll give you an example. Moved into my estate, first month of our estate, they were raising a special levy of 10,000 rand. I mean, are these people wild, right? So we're sitting in this meeting, and they're discussing. Now, we have, I think at that time we had 7 houses. We're sitting in this meeting, they're talking about the special levy of 10,000 rand. And the one lady, who, by the way, I had so many problems with because she even called the cops on me for having parties. I must just give you guys context. Everybody else there are families, and I'm the only single person there. So obviously I don't care about things like high security and all of those things, right? This lady turns around and says, looking at me in my eyes, she says, but we understand for the people that may have cash flow issues. I was like, excuse me, ma'am, who's got cash flow issues? I don't need no payment arrangement. I took out my phone, I made the payment right there and then. That's bleeding on your finances. That's allowing emotion to drive you. And that is the most important thing. It's also then taking, on one side, I've got my personal finance management checklist. On the other side, I have me. And these two people need to speak to each other. Because in reality, a lot of us, we live for today, right? It's easier to make the decision to spend today than to think that, there's a book I'm actually reading, and it speaks about the future me. And the future me is always a better person. no, I will stop eating sweets next week. This is the last time. I will start investing and reinvesting next week. But in reality, the current you is picking up bad habits that the future you doesn't even realize they're going to have.
I think we are running out of time. We're going to keep the conversation going, but I do want to just put out to the audience that we are taking questions. If you have a question, please just raise your hand. We'll get a mic to you. We'll take the question, and we'll do it in the discussion. So we'll just do it in the last sort of 5 minutes that we've got for this discussion. So if you have any questions, please feel free. We've got our roaming mics at the back, and we will take questions. Nicolette, I like that you drew the parallel between the actual checklist and emotional Nicolette, emotional Jimmy, the person that's actually making the decision. And it's funny that you bring up that kind of example around your body corporate, because I think more often than not, when you look at your bank account and you look at the bank balance and someone undermines you in that situation, the disrespect that you feel and the fact that you feel you need to prove to them is where that misalignment comes from, is then suddenly the 10,000 Rand that you were going to reserve for servicing your car goes to this new expense, and now you need to go and source another new 10,000 Rand. Credit. And that's the thing. And maybe perhaps we should look at that, right? Is there's this understanding that credit is a nightmare to go through, and we've all experienced that, where banks call and banks come and repossess things and all of that. But there is the other side of credit that you can use for leverage, right? And I'll give this an example. I've got a friend of mine who works at one of the banks, and he says to me, he started a property portfolio last year, and he bought one property on credit, and he leveraged that on credit to buy another 7 in less than 12 months. The man is sitting on 8 properties that are in a credit ecosystem that pays for itself, and he has to monitor and make sure that that's okay. But that's a decision he's made for future him, not for current him. And I want to look at that as how do you then leverage off of things like credit to build a profile, to build a buffer, to build a security without jeopardizing the checklist and without jeopardizing or putting yourself at an awkward risk position or in an awkward risk position.
I think it's the foundation, right? Your friend, the only way he was able to do that is simply because he had a spectacular credit profile. And I think people take for granted having and investing in your credit score. And I always say it's important to invest in your credit score, whether it's yours or whether it's your business's credit score. Because that's ultimately the foundation that tells the banks that you understand the type of risk that is being taken, right? So I think that's the first thing. The second thing is, can we stop being afraid of credit? Like, guys, credit is there. But you have to be very, very strategic with how you use credit. Because let's be fair, credit is a facility. The liability only happens when you use the credit line. So a lot of people, what they do is they actually take up and rack up a lot of credit facilities so that by the time they actually need to use it and turn it into that liability, it's almost you're negotiating at an advantage with the banks, right? So you can literally say, you guys gave me a credit card last month of, let's say, 13%, right? You sit on it. You don't use it immediately. You sit on it. And that's why we say some of these things you've got to plan pre, right? You sit on it. When you do need to go and take out and use that credit, you go back and renegotiate. Because essentially what you do is you put your own income on the credit card, you use the credit card, so the credit line is actually quite active. The bank sees it as active. So then when you go back, you're asking for a bigger facility and you say, let's renegotiate the interest rate. Because ultimately you are somebody that they can now trust because you've got a credit line that you have been using.
You are the commodity. I think we often don't remember that, especially when dealing with banks, is at some point if you have the income, if you have the credit profile, the bank kind of needs you in order for them to give you the credit. They can't just sit on idle cash, and I mean, I'm sure they've got places they can repurpose it. But I like that you bring up the intelligent use of credit and the responsible use of credit, because that's something else where a lot of the times we sit and we say, I don't have enough income, I don't have enough earnings to do this or to make these decisions. And so we delay the decision.
Yeah.
But if you understood that you can leverage off of other things, you might find yourself being able to afford or achieve more than what you're able to. As a parting shot, if you could give one final thing to put on the checklist, what would that be?
I would say traders are humans, right? Traders are going to get married. Some of you are going to get married in community of property. It is pertinent to understand where the law transcends with finances. We find that a lot of people, especially self-employed people, entrepreneurs, traders, investors, who are not in the formal employment, they know how to make money, as I said, they understand the fundamentals, but they get beaten by the small things like your marital regimes. Things like what happens to your not having a will, dying interstate. So things like that. So I think it's important, sit with a lawyer and ask them, where do your finances transcend with the law, and buffer yourself there.
I think we'll leave it at that. That's such an important point to leave it on, is don't be afraid to seek advice. Speak to a financial advisor, speak to a legal advisor, actually get answers to the questions that you have, because for as long as the questions continue to sit in your head, they will continue to remain unanswered. On that, I would like to open it up again for questions. If there are no questions, then I think we'll close off. There we go. There's a question over there.
Don't make it difficult, my sister, please.
It's late in the day.
Hi everyone, my name is Nomcebo, and the moment you said that, now I'm worried about my question.
I'm just joking.
Let me make it easy. So as a financial educator, what are some of the challenges have you had to go through in terms of regulation? We had a panel previously to this one where we were talking about some of the FSCA regulations that you need to go through. What separates you from a financial advisor? And what are some of the challenges you've had to face as a financial educator? Because a lot of people will be like, well, you need to be regulated to give certain kind of advice. And on the previous panel, we learned that whether you are aware or not aware, but some of the things that you do say, they do come out as financial advice.
Absolutely. Thank you very much. That's quite an important question, because I think in this day and age, we each giving each other advice around the braai stand and whatever, right? So luckily, when I started, right, one of the first decisions I made was to be very, very blatant and clear that I don't do financial advice. Even when I was partnering with brands, I would make it very clear to them that I don't do consumer targeting campaigns. I do financial education. So for instance, I will speak about, I'll give you an example. Let's say, for instance, my content is sponsored by an Old Mutual. I will speak about a tax-free savings account, but I won't speak specifically about their tax-free savings account. And that is because there's an act called the FACE Act, right, that regulates how and what is financial advice. In the simplest of terms, and I'm sure you've heard it from the previous panel, giving advice, making recommendations, giving guidelines. And the guidelines is where a lot of financial influencers and content creators get lost, right? So I've used the platform and I come and say, oh, amazing platform, this is how you register on it, this is how you use it. You could potentially be skidding very, very close to giving a guide to the next person. So I think language is very important. Last year, I got appointed on the FSCA Consumer Advisory Panel. And one of the portfolios that I do handle is exactly that, is how do we create regulation for content creators? How do we create regulation for financial coaches? How do we create regulation for financial platforms? And I'll give you an example. You take a platform that, I'm just going to throw a platform around. Frank, for instance, right? It's an investment platform. If I am joining a campaign on Frank and they give me a code, for instance.
A referral code.
A referral code. And I make money from that referral code. My call to action when I'm putting that content out is going to be, go onto Frank, download Frank, and use Frank. Now, the argument that people are making or platforms are making is that it's not really financial advice because all I said is get the platform. But there's only 2 products on that platform. So essentially, you're going to take either one of the 2, and that becomes advice or recommendation. So I think the challenges that I've come across is how to use language correctly, But I think also South Africans don't know their rights and responsibilities. I think a lot of South Africans are allowing people to give them financial advice without realizing that they are being given financial advice. And then I think the last thing that I got, which was a big pushback, was on the educational front, which is another thing that we're trying to push with Treasury and the FSCA, is to have a formal NQF qualification for financial coaching or financial education.
Thank you very much for that, Nicolette. I've been told that we unfortunately have run out of time. We cannot take any more questions. If you do still have questions, I'm sure Nicolette will be available after the session to answer those questions. My friend, thank you so much. This has been fun.
Amazing.
Thanks for the time, thanks for the insights, and thanks for being willing to share what you've learned and the difficult lessons that you've had to learn along the way.
Thank you so much, Jimmy. Thank you for everybody. You could have been anywhere in the world, but you chose to be here with us, and we appreciate it.